Last time we caught up about our budget predictions, expectations, and some of the measures that had already been announced, and now we've had the budget. So on this episode, we're going to be recapping specifically points associated with business and business owners. There was a lot, I think, of other policies, other announcements, economic, political, and all sorts of other issues and talking points that have come out of the budget. But for the purposes of this, we want to focus on those affecting our clients and other business owners. And I don't know, Sophie, if you want to kick off with something that caught your eye specifically before we get into the detail, but where do you think we need to sort of start in recapping the budget?
Yeah, I think one thing for me is the increase or in length of time, as it were, for the freeze on thresholds.
Mm-hmm.
I mean, and we think, maybe it's not such a big impact, but I like to sort of have a look at the numbers, as you know. And I thought, well, if you were paid 50,000 back in 21-22,
yep.
And that's the near where the threshold is for basic rate before you go into higher rate tax. And you had a inflationary increase in your salary during that time to now. And then you continue to, say, at an average inflation of 2.5%. By the time we get to 30-31, you'd be on, say, 70,000. And you might think your lifestyle would be kept up with that. But because the thresholds have been frozen, you'll actually end up paying, I've worked it out, I think as a nearly 5,000 extra of tax. That's 7 percentage points of income tax increase.
Really? Oh, okay. So as if they'd put 7p on income tax, it's the same impact just with these rates. Because, of course, if you're on 50,000, you'd expect the high rate threshold to move with your wages and effectively stay within that. So once you jump to the 40% tax rate, wow. So recap that, £5,000 extra in tax.
Yeah, nearly 5,000 extra in tax a year. Yeah.
And that people will really feel that, I think. And as you say, it kind of feels like it's some, accounting adjustment and I'm getting a pay rise, so I'll see more money. And people will, of course, see more money, but ultimately not as much as they probably should have done. Interesting. Yeah, so I think that's an area that's been well covered, and we are yet to see that sort of pan out in full. Forever kicking the can down the road of the freezing of the allowances, I think has been mooted that it will bring a lot more people into tax, including pensioners in a couple of years' time, and also lots of people at that higher rate threshold. And from our point of view, in terms of helping clients with planning their remuneration strategy, that £50,000 threshold and then the £100,000 threshold where the personal allowance starts to be withdrawn is important. And, you go back to that year you were talking about, 21-22 or earlier, talking to a client about, well, we'd like to cap your income at 50,000. That's absolutely fine. Whereas now, these days, somebody running a family with a modest mortgage, day-to-day living expenses, £50,000 drawing from their business makes things quite tight, doesn't it? Yeah. So, Sophie, I guess that then leads us on to talking about the rates of income tax, which, highly publicised, have not been increased for working people. We've now got a clear idea of people that aren't considered working people. In summary, people with property, people with savings, people who draw their money through dividends. What's been changed in terms of their income tax rates?
Yeah, so from April 27, for property income and for savings income, interest, things like that, we're going to see a 2% increase across the board for basic rate, higher rate and additional rate. And so the basic rate will be 22%, the higher rate 42%, and the additional rate 47%. Yep. And it's just worthwhile pointing out that if you were someone who made charitable donations through gift aid, that your relief will remain at the main rate.
Right, okay. Yeah. And that comes in April 2027.
April 2027.
And that affects, as you say, basic, higher and additional. So in contrast, for dividends, both the dates and the rates are slightly different.
Yes, that's right. So from April 26, you'll see an increase in dividend tax rates. For basic rate taxpayers, it will go up. It will be 2%. It will go up to 10.75%. And for higher rate payers, it will go up to 35.75%.
Yeah.
But additional rates will stay where they were, which is 39.35%.
Which is interesting. Comes in a year earlier, but additional rate tax on dividends hasn't been changed. I don't know the logic behind that, but I just think it's interesting, the actual percentages that we've ended up in with here, Sophie, because you kind of look at 35.75 10.75. You know, I know that the origins of this is that there used to be a 7.5% tax on dividends and other rates before that, and then there was a 1.25% levy put on by the Boris Johnson government, I think, for care homes, and then the policy was reversed, but the tax remained, and then we build on the 8.75 with another 2%. Doesn't it feel like it'll be quite easy to round these up a little bit in the future and go again?
Well, you heard me just struggling, didn't you?
Yes, right.
If I can't remember them, who's got any chance? But it makes. Well, the whole picture is very complicated.
Yeah.
I was trying to work out some scenarios, which I always find helpful for today. And it does, because everything, we've got national insurance to think about. And if we compare with salary, we've got the employment income, you know, the regular tax rate. We've got dividend tax rates at different levels, but also the corporation tax rate, which again, that changes depending on which band you're in. I think the take-home message is I can't give you a one size, back of an envelope, everything one size fits all solution. No. I think it's just contact your advisor,
absolutely,
work through the numbers in your own case. And the other thing is for people that have reached state retirement age, salary is going to be better probably because of the there's no employees national insurance, and that again changes the figures. I think just looking at it as a very general thing, if your company profits get to 400,000 and you're taking everything out of the company every year, then that's the point when actually you'd be better off paying salary than you would drawing dividends, right, which would be the what we'd normally say.
Yeah. As you say, every scenario is different, but as accountants, obviously we're quite dry and don't have much of a sense of humour. But the number of income tax rates now, when you look at 20, 22, 40, 42, and all the dividend rates and the additional rates as well, it is a bit of a minefield. And for your simple business owner that isn't getting good advice, must really struggle with this. So the message there is to get in touch and see what we can help with. Right, Sophie, let's get into some more technical points now. So firstly, employee ownership trusts have become quite popular in recent years, whereby a business owner can transfer the ownership of all or part of their business to their staff effectively. And there were some tax incentives to encourage business owners to take this route in terms of selling their company and moving it on to the workers to run this going forward. But there's been a change, I think, in the amount of tax relief that these transactions used to be entitled to.
Yes, that's right. So the business owner used to get full tax relief, but right from budget day, that's been stopped. So there's still some relief, but only at 50%. So if you're a higher rate taxpayer, your capital gains tax rate would be 24%. So you would have a reduction of that, and so the rate to sell into the employee ownership trust would be 12%. Which is still better than business asset disposal relief, which is due to be 18% in a few months. But you can't use the two in conjunction. You can't get a 9% rate, I'm afraid. It's one or the other.
I think that was one of the points that you sort of jumped on immediately when the budget was sort of being read out. It probably slipped under most people's radars, but you kind of think, okay, so do you still get your first million at a reduced rate and then the effective 12% rate? But that's not the case. So effectively, business owners should look on this as a 12% capital gains tax rate on the sale of their company.
Yes, I think so. But one of the reasons the incentive was there was it can be quite a bit riskier to do that than to sell to a third party or say, here's your cash, have it tomorrow. Yeah. And the chances of you actually getting all of your income because it's deferred, or not income, the sales proceeds, because it's deferred. And if that business is to fail in the meantime, I think that's why the rate was where it was. Yeah,
you might not get paid in full. I don't know whether this is one of those sort of clever policies. You touched on some ideas in our previous podcast, and it feels like speaking to some people that were considering EOTs before the budget and catching up with them afterwards. I think initially the thought was, well, there's no point going down this route anymore. And then I think, that the kind of thoughts have come back to saying, well, actually, maybe 12% isn't that bad looking at the alternative. But you're right, it's a balance towards will you get paid in full or how much of the proceeds would you get versus the lower tax rate. So it may well be that we do see these continuing. And there is a bit of a tax take for the Chancellor. So maybe she has hit upon a blend that works. But ultimately, as you've said before, very easy to play around with a 50% discount and reduce it further in the future. We shall see, I guess.
Yeah.
Talking talking about some other acronyms, we move on from EOTs to VCTs and EIS schemes. So these are where individuals can invest in shares in certain qualifying companies and receive some tax relief in order to incentivize investors to invest their own funds into certain higher risk businesses. What's changed on those?
So mostly it's the eligibility of the companies. So in most cases, the size thresholds are doubled. I mean, I don't want to go into the real technical detail of it, but it just means that more companies are eligible for longer.
Yeah, okay.
I think as they grow. But I think the one key thing that does affect the individual is that for the VCTs, venture capital trusts, your income tax relief in that first year of investment may be reducing. You used to get 30%, but now you'll get 20%.
Oh, I see.
And that's from April 26, these changes.
So a bit less tax relief, but over an extended period of time.
Yes, you can invest for longer in those companies as they grow.
And the final acronym in this little portion is EMI schemes, so share option schemes for workers within companies, and there's been some changes there as well, hasn't there? Yeah,
again, it's the companies that are eligible, the size of them mostly are doubling. So,
okay. So for anybody, for anybody considering these types of schemes, they should get into. They probably already are. These are quite highly technical schemes and things to be getting involved in. So speak to your accountant and advisor on any of these. So next up, Sophie, we're talking about business rates, and I think we both jumped on a call immediately with the local newspaper to write our column straight after the budget, and I think this was something that, on face value, sounded like a really good deal for businesses. And actually, as with a lot of these things, once you get into the small print, the story isn't quite as it seems. And I think the headlines around business rates and the changes coming are almost three-pronged in terms of the value of the premises going up, the discount applied to that for certain types of businesses changing, and then some legacy discounts associated with COVID and other things falling away. And the full picture is quite tricky to get to. But when you do start to look at some examples, there could be some quite large chunks of extra business rates having to be paid by certain businesses. Try and decipher all that for us, if you would.
Yeah. So I think, first of all, it's perhaps worth pointing out that if you're a very small business and you're renting somewhere that's got a rateable value of, say, $12,000 a year, then with small business rates relief, you don't pay any business rates. So that's right down the bottom end.
Yeah, 12,000, okay.
Yeah. And that tapers to 15,000 when you're then on the full scheme. During COVID and those sort of post-COVID recovery years, specifically for the retail, hospitality and leisure industry, there was a 40% reduction in the rates that were applied to them. And every 3 years we get a revaluation. And the one that's due to come in for April 26 was based on April 24 values. And so the last time that properties were revalued was in April 21. So that was right in the middle of COVID years. And these types of businesses, the rents tended to be a bit lower at that time because the landlords were trying to keep people in business, I suppose, keep their tenants going.
Of course, yeah.
And so the government are predicting sort of 30% increase in rateable values for these specifically types of properties. So they're losing the 40% and they're gaining a 30% increase. So how the rates are worked out, there's a multiplier that is applied, so many pennies in the pound, to the rateable value.
Right.
And then there was a discount. Yeah. So those things are sort of coming together. And so it's the multiplier, the one that before the discount, before the 40%, that's the one that's being pulled back.
So that's being reduced.
That's the reduced one. And so that was the big announcement. But actually, when you look at the numbers, always look at the numbers, James. And when you look at the numbers, for a lot of businesses, they're going to see an increase from where they were 25, 26 to where they're going to be 26, 27, and certainly when they get to 29, 30.
So rateable values going up because the last valuation was done in COVID, suppressed valuations at that stage. And those specific COVID discounts of 40% or so, they end next March. And the great news is that the government is bringing in a slightly lower percentage rate. However, that's not going to be good enough, is it? So are there any additional discounts for certain sectors that have been brought in to help with that effective jump in the actual business rates bill?
Yeah, so there's some transitional relief available to try to ease over the next 3 years.
Mm-hmm.
But I don't know. I mean, we've government have given us some examples, and perhaps it's useful to run through.
I think it might be useful to talk through one or two of those just to kind of understand, all right, there'll be a lot of numbers quoted here and you know, feel free to get in touch if you want a copy of this. But ultimately, I think it does, when we read through these before we started recording, I think it does illustrate how actually it's not all as it seems. So, why don't you take us through one of those?
So first of all, it says that for the sector, we're only looking at maybe 4% increase. Mm-hmm. But these are their own examples that I'm looking at here. So, for instance, if you had an independent pub with a rateable value of 30,000 in 2023, when we get to 2026, we'll see a 15% increase in their business rates.
Value,
and then when we get to the end of the transition period, 29-30, it will have been a 45% increase.
Right. Okay, that's really interesting, actually. So, actually, for that £30,000 rateable value small pub that many years ago, the business rate is actually jumping quite significantly. What about a slightly larger pub with a higher rateable value? Is the impact still the same?
Yeah. So again, this is an example from the government website. They're looking at something with a rateable value of 50,000 back in 2023. They're going to see a 30% increase. And they get to the 26 on their business rates payable. But after the transition period, 215% increase.
Really? Wow.
Yep. I hope I've worked my numbers right, but that's what I see.
That is quite the jump. Yeah, absolutely. So 30%, that's 30% increase. So that kicks in April 2026. And how long's that for?
So it goes through to 2029.
2029, election year. Mm-hmm. Interesting to see whether anything's done about that. But that just feels completely unsustainable. You know, a 215% increase just sounds absolutely crazy, doesn't it? And what about those on the smaller end? So that are just above the small business exemption. Are they seeing a similar type of increase?
Yes. I mean, in fact, you might have seen a very small place that maybe wasn't paying anything at all and is now suddenly into this. It might be very hard indeed. But on 15,000 back in 2023 rateable value, we'd be looking at an 18% increase when we get to April 26. And then after the transition, when we get to April 29, it'd be the sort of 70% increase.
Right, okay. Yeah. Thinking about the types of businesses that we speak to and we look after here at Lovell Blake, that clearly that after it unwinds in 2029, that's absolutely unsustainable, and I would assume other measures would come forward at that stage. But even so, in the lead up to that, with the new discounts applied, firstly to market that as a really great deal and an offer to the sector, I think is being somewhat short-sighted, because as we both know, these types of businesses, they employ a lot of people. They're already coping with the employers' national insurance increase last April, and that's not all, is it? Because wage rates, national living wage, will also have a big impact on these types of businesses. They tend to employ people at the lower age range, around the 18 years old, and that's going to have a big impact as well, isn't it?
Yes, I think so. And again, we're looking at the headline numbers. I was going from £10 an hour to £10.85 an hour for someone who's 18 to 20 years old. And you might think, well, it's only 85 pence. But when you start actually looking at it, you might conceivably have, I don't know, someone doing 2 5-hour shifts a week at that age.
Yeah.
And at the moment, you're not paying any employer's national insurance at all. And now you're going to be on the increase that it will come through. So rather than an 8.5% increase in your wages bill, it's more like nearly 10. So it's again, always look at the numbers. I think the headline is just...
absolutely. Yeah. And that I think that's really important, because we saw, as everyone knows, not just the increase in the employer's national insurance rate to 15% April this year, but as many people have pointed out, that reduction to £5,000 as to the entry level. And doesn't it feel logical to increase the living wage rates? You would also increase the entry point at which national insurance is payable. But no, again, we've even got fiscal drag on the newest policy. That £5,000 limit is still in place and hasn't moved, whereas everybody's wages have grown. And for those that now go over £5,000 a year, national insurance at 15% on the excess can be significant.
Yeah, indeed.
Next up, let's just refer back to a point we've touched on previously, which is MTD, Making Tax Digital, which is coming in for smaller sole traders and landlords next April. But I think you've spotted something in and amongst the announcements with regard to this that could be leading to potentially us all paying tax a bit earlier in the future.
Yeah, so whether we start with a little reminder, those that have got self-employed, this is turnover, so it's not profit, of 50,000 and or a rental income of 50,000, and it's a combined total. Will be coming into Making Tax Digital, which is quarterly submissions. The records have to be in a digital format, and that's happening from April 26. And then the threshold is dropping so that when we get to April 27, it's 30,000 and then 20,000, which is going to be a significant proportion of people that are self-employed and landlords are going to be caught. Then that will happen from 2020. Where are we? 2028.
Yeah, so a business turning over 20,000 or even a landlord with 20,000 worth of income, they're not massive organisations, and quite often those might have semi-manual records or even manual records. So to have to digitise their affairs, I think we're seeing it coming with 50,000, but that dropping to 20,000 threshold in the next couple of years is significant, isn't it? And why do you think all businesses are being required to do more and more online and file more regularly? Is this leading to, you think, HMRC asking us all to pay our tax a little bit earlier? I assume it is.
Well, yes. I think, there are two prongs to it, I think. One is that they hope it will reduce errors, but we'll see where we go with that. Yeah. And then the other is, I think, will be perhaps to quarterly payments of tax.
Which large companies already do, don't they, based on the previous year's profits, but actually to do that in real time, report a profit figure and pay some tax on it, feels to be where we're heading, and I think where some other countries that are a little bit ahead of us are already doing. And
it'd be very nice for the government that's in power when that happens, because their tax receipts in that year will effectively double almost, because they'll have...
they'll have the previous year in arrears and then the current year, not in advance, but in real time almost.
It was one of the things that was announced with the budget, was that from April 29, more self-assessment was going to be collected through PAYE. If you also have PAYE income, they'll try to use that to collect the tax on your other income through PAYE more.
And that's been an ongoing process, hasn't it? I think... the payrolling of benefits and also more generically, the number of clients I speak to about they get where they've got a wage, they've got a salary through their company, they get their tax codes through, and they're, why are the HMRC collecting income tax on my savings income or investment income through my tax code? And whilst at the moment you can say, no, we report this under self-assessment and pay in January and July each year, HMRC have been sort of trying to get more and more income on that tax code just because they get their money earlier, isn't it?
Yeah, and some clients like it from a cash flow point of view, and they actively want to have dividends or bank interest or rental or something put in that code. Yeah, that's right. At the moment, it's a choice.
Yeah, it's no surprises then, is there? So leading on to one of the slightly more high-profile announcements in the budget, and what some are calling the mansion tax, but ultimately is an additional tax charge on ownership or residency of larger properties. I think there was a little bit of confusion around who would actually be have to pay this new tax charge. But can you just outline for us who's caught by this and when it comes in and how much we're talking about?
Yes, as I understand it, it's property owner, not the occupier, who will be paying it. I suppose in most cases, the authorities are hoping that will be one and the same person, so that will make it easier to collect. So the local authorities will be collecting the tax with council tax, but they won't get to keep it. They'll have to send it straight on to the Treasury.
I see.
It starts at £2 million for properties worth £2 million. There's £2,500 per year. going up to 7,500 for properties more than 5 million.
Okay, so a slightly sliding scale above 2 million.
Yeah.
But I think you've spotted some behaviours in the past where there's a similar arrangement around residential properties, and the entry threshold is may be open to reduction in the future.
Yes, I know. So I'm too cynical. But I just remembered when I saw that 2 million, I thought, oh, that reminds me of the annual tax on envelope dwellings, which came in 2014, I think, and that was £2 million to start with for properties which were within a corporate envelope within a company. And then the next year it was then £1 million was the threshold, and then the year after that it was only £500,000. So I don't know. Perhaps I'm too cynical. I think.
Well, I think we can all be cynical at the moment, can't we, in the current environment? But that is interesting. Yeah, you're right. I think 2 million feels like, I think the statistics were 60% or more of houses caught are in 4 specific boroughs in London, so it's really not impacting a huge number of people in our region. But ultimately, once that policy is into law, it can be easily adjusted downwards and bring more and more people into this. So potentially something to be looking out for. Yeah,
and I think in the east of England, I think their numbers are that they're expecting between 5,000 and 6,000 properties to be caught.
Yeah. So still relevant for many. So finally, before we wrap up for this edition, Sophie, I think we touched quite heavily in our pre-budget prep on inheritance tax, and there were some tweaks around the edges, I think, in the budget, but not as much significant action as we'd feared. Do you want to just recap what was changed before we talk about what may come later? There wasn't too much, was there, in the end?
No, I think it was just something that makes you wonder now with reflection. You thought it was a good thing when we heard it last week, but I thought, well, why on earth wasn't that announced last year when these changes were first proposed? So at the moment, a married couple or civil partners, they have 325,000 nil rate band each. If one goes before the other, then that gets transferred. So it really helpful from an inheritance tax planning point of view, but also from a lifestyle that they don't. That half the assets don't have to go on the first death. Yeah. It can be held by and that is very, very helpful if it's your main property, say, is your home or something. So that wasn't going to be the case when they brought in the £1 million 100% relief for agricultural property and for business property. That was just going to be per individual, and if you didn't use it, you lost it. Lost it, sorry.
Lost it, yeah.
But then what has been announced in the budget is that will now be transferable in the same way as the nil rate band.
Which makes sense, doesn't it? It kind of felt like an oversight initially not to have that as transferable. And I know business owners and farmers have been working in the lead up to the budget to redraft wills, so that sort of the common strategy is, well, how can we value £1 million worth of assets reliably that's future-proof, and then we leave that to our children, taking advantage of the allowance, and the rest to the surviving spouse. Now, that's not required. You can leave everything and the allowance goes with it, as you say. Just feels more straightforward and something that should have been the case already. Not necessarily a giveaway, because with a bit of planning, I think the same result could have been achieved, but it just means that it makes it a little bit more straightforward.
And I think it's helpful, especially like in the event of an early death, for instance, when children might still be young. Or they've also said that if your spouse has passed away before April 26, you can still have their allowance, even though there wasn't such a thing back then. So that's useful in those two particular situations, I think.
That's a good thing. And then also, we now seem to live in a world where no change for the worse is a good thing. And we were talking previously about how the 7-year gifting rule may well be extended or completely abolished. We still have the 7-year rule, don't we? And the general inheritance tax rules remain in place with regards to potentially exempt transfers, chargeable lifetime transfers and other things. But interestingly, the nil rate band and the residence nil rate band is also suffering from fiscal drag. It's being locked in, and therefore as property prices increase and asset values increase, more and more people will be dragged into inheritance tax, won't they?
Yes, and again, going back to that £1 million, we were promised that would go up with inflation, but that's been the same across the board. All the thresholds frozen until 31.
And looking at it slightly politically, it does feel like this might well not be off the table forever. We've been told that the Chancellor won't need to come back again, and she said that last year. So ultimately, it feels like they have now opened the box in terms of mansion taxes and such like. So that targeting of wealth rather than income appears to be an area that they're not afraid to go for, and ultimately looking at income tax rates, thresholds, allowances may well be something that remains on the agenda and something we're talking about in the months and years to come. So we shall see.
Absolutely.
So I think in summary, Sophie, there was quite a bit of specific content in there. And whilst this podcast might not flow as well as some others, I think it's really important to focus in on those specific areas, and some will be of crucial importance to some and not to others. We'll obviously tag up the podcast certainly on YouTube so that you can jump to the areas that are important to you. But the message on the whole, as ever, is if anybody has concerns in these areas, you and your team are here to help.
Yep, absolutely we are.
Yeah, good. So as I've said before, it's me, it's Sophie, it's our team here that you would be dealing with here at Lovell Blake. If you have got any questions, please do get in touch. But for now, until we have more news in the lead up to the spring statement, I guess, I'll say thank you very much for joining us, Sophie,
Thank you, James.
See you all again next time.